All right, I should be live. How's everybody doing today? Let's keep an eye on the live chat. Few people are in there. Am I live? Audio good, video good. And then we'll get rolling. Oh, shit. How's everybody? There we go. All right, I guess I'm live. I got a new background. Unconfiscatable. Coming to Las Vegas, September 16 to 19. I will have more info on it soon, including where the event's going to take place. Haven't done a show on this channel in a while. I think I did one from Dubai for a little bit. I'm back in the US. That was a short trip to Maldives to check out the venue for the financial summit. And then had some really nice dinners in Dubai. I gotta say, I do miss the food. There's some amazing restaurants over in Dubai. All right, let's go take a look at the charts. I believe the rate decision has been made. I'm going to look at the chart first, and then I'll be able to tell you what the rate was. So nothing's moved. Interesting. 5-minute chart. Rate decision was done on this candle. Nope, on this candle here. The market initially went up, which tells me that, well, they clearly didn't raise the rates. If they had raised the rates, the initial reaction would have been to crash. So I'm assuming the rate remained the same, because if he lowered the rate, the market would be up like 1,000 points. Hey, Motorist. Hey, Mal. Thank you for being moderators. Shoot over questions in our live chat Telegram group. Blockchain circles. You're welcome, buddy. All right, so let's go to the Fed's website. We're going to catch the live stream. That's coming up in 15 minutes. So we'll see what he has to say. Oh, I should put a second mic to my speaker. Rate unchanged. Yeah, I assume so, based on the price action in the charts. Okay, so let's see what the press release was. All right, let's let the AI read it for us. I can't read. Influencer friendly, thank you, I guess.
Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong, and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated.
Let's do this differently. First off, I think it's a little fast, even though it's only at 1.2. All right, let's try this. Let me know if the audio is good. We're going to restart this.
In recent months, there has been a lack of.
Hold on.
The committee seeks.
Hold on. Here we go.
Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong, and the unemployment rate has remained low. Inflation has eased over the past year but remains elevated. In recent months, there has been a lack of further progress toward the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieving its employment and inflation goals have moved toward better balance over the past year. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $60 billion to $25 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion and will reinvest any principal payments in excess of this cap into Treasury securities. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Voting for the monetary policy action were Jerome H. Powell, Chair, John C. Williams, Vice Chair.
All right. So I understand why the market spiked to the upside at first. It was that the Fed is going to start to sell their balance sheet less quickly. So they're gonna still sell, but they're gonna sell at a decelerated rate. Hey Zazo, welcome to the show. Let me see. I have been saying since last year that the Fed will not lower rates this year. They may lower it by 1/4 of a basis point just to keep the trolls off their back, but they're probably not going to lower the rate. So interesting. Oh, that's the current one. I guess some were expecting it to raise the rate. They did not. Let's see what the June's expectation is. Mostly unchanged. 9% chance of lowering with a 1% chance of rising. That's interesting. What about in July? That's insane. Let's move on. That's more insane. Wow, so the market is really pricing in a 40% chance rate hike by the end of September. 40%. Actually, no, I take that back. 50%. 48% chance of a rate hike before end of September. And a 60% chance of a rate, sorry, not rate hike, rate lowering. And a 60% chance of rate lowering by November. And a 75% chance of a rate lowering this year. Yeah, I would take the under on these numbers. Hey, so in 10 minutes, he's going to go live. So before he goes live, I'm sure all of you are aware Roger Ver got arrested in Spain. I think I need to do I think I need to do a law show pretty soon. It's been a while since we did a law show. And I don't know why the DOJ has 2 different posts about Roger getting arrested. It's weird. They have 2 different press releases. So let's read them both. Let's see if there's any differences between them. And then I'll say a few words.
Man known as Bitcoin Jesus evaded nearly $50 million in taxes. An indictment was unsealed yesterday charging Roger Ver, an early investor in Bitcoins, with mail fraud, tax evasion and filing false tax returns. Ver was arrested this weekend in Spain based on the U.S. criminal charges. The United States will seek Ver's extradition to stand trial in the United States. According to the indictment, Ver, formerly of Santa Clara, California, owned MemoryDealers.com Incorporated and AgileStar.com Incorporated, 2 companies that sold computer and networking equipment. Starting in 2011, Ver allegedly began acquiring Bitcoins for himself and his companies. He also allegedly avidly promoted Bitcoins, even obtaining the moniker Bitcoin Jesus. On February 4, 2014, Vays allegedly obtained citizenship in St. Kitts and Nevis and shortly thereafter renounced his U.S. citizenship in a process known as expatriation. As a result of his expatriation, Vays allegedly was required under U.S. law to file tax returns that reported capital gains from the constructive sale of his worldwide assets, including the bitcoins, and to report the fair market value of his assets. He was also allegedly required to pay a tax, referred to as an exit tax, on those capital gains. By February 4, 2014, Vays and his companies allegedly owned approximately 131,000 bitcoins that traded on several large exchanges for around $871 each. Memory dealers and Agilestar allegedly held approximately 73,000 of those bitcoins. Vays allegedly hired a law firm to assist him with his expatriation and to prepare his expatriation-related tax returns. Vays also allegedly hired an appraiser to value his two companies. Vays allegedly provided or caused to be provided false or misleading information to the law firm and appraiser that concealed the true number of bitcoins he and his companies owned. As a result, the law firm allegedly prepared and filed false tax returns that substantially undervalued the two companies and their 73,000 bitcoins and did not report that Vays owned any bitcoins personally. The indictment further alleges that by June 2017, Vays' two companies continued to own approximately 70,000 bitcoins. Around that time, Vays allegedly took possession of those bitcoins and in November 2017 sold tens of thousands of them on cryptocurrency exchanges for approximately $240 million in cash. Even though Vays was not then a U.S. citizen, he was still legally required to report to the IRS and pay tax on certain distributions such as dividends from memory dealers and Agilestar, which were U.S. corporations. Vays allegedly concealed from his accountant that he had received and sold memory dealers and Agilestar's bitcoins that year. As a result, Vays' 2017 individual income tax return did not report any gain or pay any tax related to the distribution of memory dealers and Agilestar's bitcoins to him. In total, Vays is alleged to have caused a loss to the IRS of at least $48 million. Acting Deputy Assistant Attorney General Stuart M. Goldberg of the Justice Department's Tax Division in U.S. Attorney Martin Estrada for the Central District of California made the announcement.
All right, so let's read the other one and see if it's any different or they're identical, because the title is different. So let's see what happens here. I just want to know all the information before I comment.
Los Angeles, a federal grand jury has indicted an early Bitcoin investor and promoter who obtained the moniker Bitcoin Jesus on fraud and criminal tax charges, the Justice Department announced today. Roger Keith Vays, 45, a former California resident whose most recent residence was in Tokyo, Japan, was arrested this weekend in Spain based on the U.S. criminal charges. The United States will seek Vays' extradition to stand trial in the United States. Vays is charged with 3 counts of mail fraud, 2 counts of tax evasion, and 3 counts of subscription to a false tax return. According to the 8-count indictment returned on February 15 and unsealed Monday, Vays, formerly of Santa Clara, California, owned MemoryDealers.com Incorporated and Agilestar.com Incorporated, 2 companies that sold computer and networking equipment. Starting in 2011, Vays allegedly began acquiring bitcoins for himself and his companies. He also allegedly avidly promoted bitcoins, even obtaining the moniker Bitcoin Jesus. On February 4, 2014, Vays allegedly obtained citizenship in St. Kitts and Nevis and shortly thereafter renounced his U.S. citizenship in a process known as expatriation. As a result of his expatriation, Vays allegedly was required under U.S. law to file tax returns that reported capital gains from the constructive sale of his worldwide assets, including the bitcoins, and to report the fair market value of his assets. He was also allegedly required to pay a tax, referred to as an exit tax, on those capital gains. By February 4, 2014, Vays and his companies allegedly owned approximately 131,000 bitcoins that traded on several large exchanges for around $871 each. Memory dealers and Agilestar allegedly held approximately 73,000 of those bitcoins. Vays allegedly hired a law firm to assist him with his expatriation and to prepare his expatriation-related tax returns. Vays also allegedly hired an appraiser to value his 2.
All right, so the rest of it seems the same. No, it's not. No, they're not the same.
Companies. Vays allegedly provided or caused to be provided false or misleading information to the law firm and appraiser that concealed the true number of bitcoins he and his companies owned. As a result, the law firm allegedly prepared and filed false tax returns that substantially undervalued the 2 companies and their 73,000 bitcoins and did not report that Vays owned any bitcoins personally. The indictment further alleges that by June 2017, Vays' 2 companies continued to own approximately 70,000 bitcoins. Around that time, Vays allegedly took possession of those bitcoins and in November 2017 sold tens of thousands of them on cryptocurrency exchanges for approximately $240 million in cash. Even though Vays was not then a U.S. citizen, he was still legally required to report to the IRS and pay tax on certain distributions such as dividends from memory dealers and Agilestar, which were U.S. corporations. Vays allegedly concealed from his accountant that he had received and sold memory dealers and Agilestar's bitcoins that year. As a result, Vays' 2017 individual income tax return did not report any gain or pay any tax related to the distribution of memory dealers and Agilestar's bitcoins to him. In total, Vays is alleged to have caused a loss to the IRS of at least $48 million. An indictment is merely an allegation, and the defendant is presumed innocent unless and until proven guilty beyond a reasonable doubt in a court of law. If convicted of all charges, Vays would face a statutory maximum sentence of 20 years in federal prison for each mail fraud count, up to 5 years in federal prison for each tax evasion count, and up to 3 years in federal prison for each count of subscribing to a false tax return. IRS Criminal Investigation is investigating this matter. Assistant United States Attorney James C. Hughes.
All right, so that's actually insane. I'm not the one that's going to give tax advice here, but I gotta say, I'm going to support Roger Ver on this one. So yeah, so my view is, well, clearly he fucked up, and I know I don't have time to read the whole indictment. Thank you, Mel, for sending it over. It's right here. Powell's about to speak, so we're gonna go there. So apparently, they got a lot of private communication from between Roger Ver and his lawyers. This is now the second public case in the last 12 months of lawyer-client confidentiality being completely shredded. And this, and I already messaged our good friend Joe Calasari, and I have a law group as well from the law show. And again, it's cases like this that will cause America's downfall. If the United States has no confidentiality between lawyers and their clients, then the United States legal system is no different than the United States military, which I constantly refer to as complete and utter dog shit, where under full knowledge that there could be a potential use for actual dog shit in manure, which may not be the case for client-lawyer confidentiality, nor American military's competence. The U.S. passport is a huge liability, and clearly surrendering that passport doesn't seem to solve the problem either. Now, my view is the United States government. How can I say this without, getting myself in serious legal trouble with the DOJ and the feds? The last thing I want to see on this earth is any human being paying the United States government $50 million so that they can send that money to get more Ukrainians killed or continue their genocide in Gaza. So good on Roger for not giving him the money, and hopefully he hires good lawyers and that will retain his confidentiality this time to help him fight against the IRS. That's pretty much the best I can say. Okay, let's go listen to Jerome Powell. All right, can someone... I'm going to mute this. Can someone just type in here when he starts speaking so I can go back to this stuff? I think this is too long for us to read. Wow, they got the addresses and everything. That's not good, OPSEC. He's charged with a bunch of, man. I think he had 2 counts of wire fraud, right? That's what Ugly went to prison for, wire fraud. Wire fraud is basically moving money across state lines, which is pretty much everything in online banking is moving money across state lines. Eight counts in total, 3 counts of mail fraud. Okay. Mail fraud, not wire fraud. Same thing, actually. Almost same thing. 3 counts of mail fraud, 2 counts of tax evasion, and 3 counts of false tax returns. Now, I could be wrong on this. You don't have to file your taxes. Technically, it's a voluntary act. But if you file your taxes, you want to try to tell the truth to the best of your ability. And you know what I always say about taxes? You give this how can I say this? You give the government the least amount of money you can legally get away with. Powell speaking. All right, let's go.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
Audio good?
Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right. So he literally said nothing useful at all.
Question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess is the.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored
Or anchored.
stable roughly? Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Thanks for taking our questions, Chair Powell. I wonder, you know, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well. And if so, what change in conditions would merit considering raising rates at this point?
So I think
She's actually good. She asks good questions from
the
New York
next
Times.
policy rate move will be a hike. I'd say it's unlikely.
That's gonna bump the market.
Focus is really what I just mentioned, which is how long to keep policy restrictive. You ask what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Please don't call a Washington Times girl. Rachel Siegel, I think her name was.
Again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So one, let me address cuts. So obviously, the decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected, and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts. And those would be two of those paths would be that we do gain greater confidence, as we've said, if that inflation is moving sustainably down to 2%. And another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And For sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Okay.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at.
He said a couple of
really,
things useful. He's easing the market up.
This year, the first quarter is coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Oh, here we go.
Rachel Siegel from the Washington Post.
Oh, I can't wait for this genius.
You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really seeing that.
She never disappoints.
What we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that
She literally asked if there's enough months in the year.
Take longer for us to reach that point of conference. So
because she hasn't looked at the calendar.
I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
No.
Not really.
Right.
So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking. Yeah.
I'll answer your questions, Azo, after.
Yeah, Mr. if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happens. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that. No, I mean,
I wouldn't say that either.
Is of course interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one. It doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Boris from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
If a lawyer and accountant can't get a job, they're not very good at their skill set.
What I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we refer to in the statement as inflation has come down now to below 3% on a 12-month basis. It's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, the second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained. And
where is he getting less than 3% from?
Forecast that wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
Well, where did he get less than 3% inflation from? It's 3.5 right now.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up. And of course, he's Mr. Potential Growth, our star. Do you share that view? And would that imply that maybe policy isn't tight enough?
Wait, now these people want him to tighten?
I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation, also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year. And last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got more supply, But those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
But you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting?
Jesus Christ. I remember 2 meetings ago, they were like grilling him. Why isn't he lowering rates? And now they're trying to get him to raise the rate?
It's like 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in say September versus December?
No.
So we're always going to do what we think the right thing for the economy is.
With the election, there's a big difference.
That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole other set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here, and we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that, and that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December? And
there's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we're.
Well, which one is he?
Do that. I mean, you can go back and read the transcripts for every. This is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. if we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that, but they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think roughly. So yeah, I mean, it's that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Okay, Scott.
All right, guys, last question, then I'm going to turn this off. What happened to Scott?
Consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy.
Yeah, but savings accounts are up.
The thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. Yeah, I think headline core PCE peaked at 5.8. Now it's at headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. We have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation and shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
All right, I'm going to turn this off.
Essentially,
All right, I heard enough. So basically, they're going to try to keep this rate as steady as possible. And they're going to pray to the sun gods that inflation is going to go down from 3%. And I don't know where he got 3%. It's closer to 3.5%, but that's okay. He said under 3, then he said 3. I mean, he should know exactly what inflation is. It is his job. It's literally his job. And yeah, so they're not really changing anything. It's business as usual. They are probably not going to raise rates unless inflation goes up a lot or too many people get a job, I guess. I don't really feel bad about accountants and lawyers not finding work. I mean, if they were good, they'd find work. There's too many of them around anyway. But yeah. All right, Zazo, to your question, what would I ask? Every time I'm in that room, the only questions I'm asking is Powell's thoughts on government spending. And no one seems to ask him what his thoughts are on government spending. I would ask him straight up, how much do you hate Janet Yellen? What do you think about the administration's spending plan? What do you think about another $1.5 trillion in deficit this year? So whenever I am in that room, the only questions I am asking is like, what can you do to stop this out of control government spending? That would be the only thing. That's the only thing that matters. Someone else mentioned getting rid of the Fed. Getting rid of the Fed changes nothing. Absolutely nothing. All the Fed is trying to do, the Fed is like this incompetent doctor that is slapping on Band-Aids left and right and trying to stop the bleeding created by the Treasury Department, who's financing the out-of-control government spending. The Fed doesn't control fiscal policy. The Fed doesn't control government spending. So blaming the Fed for economic problems is insane. Again, it's like blaming the doctor sticking a Band-Aid on a wound that's an incompetent doctor that doesn't know how to close a wound and just slapping a Band-Aid on it. That's literally the Fed. So does the Fed not at least further distort the markets? Maybe, sometimes. You know, sometimes the Fed benefits the markets, and sometimes the Fed distorts the markets. It evens out, right? So as an example of where the Fed distorts the markets is when the Fed is too slow to start raising rates, and then they have to catch up, and they have to raise rates very, very quickly, thus blowing up 3 and more recently 4 banks. That was the Fed distorting the markets by holding the rates too low for too long and raising them too far too quickly. Okay? But on the other hand, the Fed providing liquidity to prevent additional banks from imploding is probably a benefit to the market. You know, the Fed bailing out the financial system is probably benefited the market. Now, why did the financial system go out of control? Well, because, again, the government grossly encouraged the creation of subprime mortgages. So there's even like Barney Frank talking about how he still wants more speculation in a housing market, and this is like 2006, 2007. So basically, it's the federal government that completely like takes the markets out of control, and then the Fed tries to do their best to fix it, but sometimes in their fixing, they screw up and cause additional problems. And sometimes they fix it as best they can. But at least with the Fed, there are benefits and drawbacks, At least it evens out. With the Treasury Department and the federal government, there is no balancing out. It's just infinite spending to get reelected and for insane, political motives where the national debt only rises, right? There is no good coming from the federal government. At least the Fed tries to do some good. They don't always succeed. So getting rid of the Fed changes nothing. Absolutely nothing. Oh, hey guys, I gotta grab a phone call. 1 second. All right, I'm back. Yeah, I gotta get off the stream in a bit. I gotta go run some errands. All right, looking at your comments. I don't have much of a comment on the Japanese yen carry trade. Don't really have much to say on that. Lucidar flipped. Yes, it did. Yes, it did. But the 4-hour MRI, we talked about this on our morning show. Speaking of the morning show, by the way, guys, if you're not following the Financial Summit YouTube channel, you definitely should. We do market analysis there every morning US time, evening time in Japan, where Matt McGregor is. So follow the Financial Summit YouTube channel right here for lots of awesome market analysis. And we're not the only ones on this channel. There are others. Speaking of Financial Summit, the in-person summit will be in Maldives. Absolutely awesome event that everyone should join. Man, every time I come to the Northeast, I get allergies. It's horrible. No allergies in Dubai. Not much in the Maldives. Man, there were no allergies in Rotan. Speaking of Rotan, I haven't even talked about Rotan. So if you go to my profile, I gotta do some posts about Rotan. So unfortunately, Rotan is a small island. Unfortunately, their hospital burned down. And I don't normally retweet. Like DMing me and asking me to retweet something is probably the fastest way to get blocked. Almost as fast as, hex people. But I wanted to retweet this. I know Dusan personally. Dusan was showing me around the island when I was there a few weeks ago. So the great guy runs the Bitcoin Center on the island of Rotan. I had an amazing time. And yeah, the hospital burned down. So if anybody can help out, you can donate through Geyser. And they have to rebuild the hospital. The federal government of Honduras is not going to give them much money. So the island has to take care of it themselves. I'm sure the Bitcoiners on that island will be helping, and some of the Bitcoin projects as well. Also, shout out to London Real. I wonder if he's on. Brian Rose. Brian Rose. There he is. Shout out to Brian Rose trying to become the mayor of London. So if you're in London, be aware. I think voting is this week, next week. I'm not sure when the election is, or it's coming up. So I should be following him on Twitter. Yeah, he had yeah, his YouTube channel got banned. I think he's back on YouTube. I know him personally. We hang out in Dubai every now and then whenever our paths cross. I'm not in London much. So yeah. Follow Brian Rose, and hopefully someone good finally becomes, a mayor of London. They're a long way away from a good prime minister. I mean, Margaret Thatcher ain't coming back, but motorists, you don't like Brian Rose, or are we talking about somebody else? He's probably talking about Roger. He's not a fan of London Real. I like Brian. Still better than anybody else that could be mayor of London. I need to do an analogy panel. I'm not in the same place long enough to do an analogy panel. I do need to do analogy. I don't want to take any medication. If something has to be prescribed for me to take indefinitely, I will not do it. I refuse to take medication. Also, notice how I've never missed this podcast for being sick in what, 9 years? All right, guys, I gotta get going. Nice to see Socrates back. All right, we'll take a peek at the price. Then we're gonna call it a day. Uh-oh, that 4-hour reversal, not as clean anymore. Would the Powell say something weird? No, just Bitcoin dropping. S&P seems to be okay. All right, guys. No, I just need to live in a place where I breathe better. Thanks for watching, guys. And join us tomorrow morning on the Financial Summit YouTube channel. And don't forget, Unconfiscatable back in Vegas. It's mostly going to focus on, hanging out. A little bit less of a focus on speakers. It will just be a fun time. Also, why the price is cheaper. I lowered the price. Only 300 instead of 500. Dinner, 250 instead of, what, 400? Yeah, so join us. Join us in Vegas. It's going to be a lot of fun. Scammies, yep. I just didn't want the scammies to die, and I didn't want the poker tournament to die. And I really like that stake. Anyone that was at the carnivory dinner last time, I got to secure that venue again. All right, guys. Thank you all for watching, and I will see you all on the next one. Bye, guys.